So I would like to say hello to everyone who have registered for this Market Outlook is Cash King Now program. Lots of you are wondering whether to invest or not invest. Do I keep the cash or do I take the plunge? Investing in the stock market is very tempting, especially when the stocks valuation as it is now. What goes down, you must remember, goes up. And throughout the history of the markets, throughout the world, we've had, markets going south and stocks, climbing up due to sentiments and hopes. The current hopes that is, held out is there will be a panacea, there will be a cure for COVID-19. They're hoping by end of the year or maybe early next year. So people are actually positioning themselves to make money. So I'm not an expert, neither on the market nor on investments. I organize with my team programs bringing experts, all right? And we parade experts and we quiz them and we get their expert views so that you can benefit from their viewpoint, and then you can make an informed decision. Ultimately, it's you, not anyone else. It's your money and it's you. You've got to decide how you're going to, invest your money and how carefully you can invest and cleverly invest. You've got to be a smart investor. Investing without knowledge is a gamble. So, well, today, SIS is very fortunate to have three prominent investment gurus. They're very well known in our local market. To begin with, we have Vasu Menon, who is Executive Director, Investment Strategy at OCBC Bank, Wealth Management Unit, on your extreme left. Thank you, Vasu, for putting up your hand to join us. We have Terence Wong, who is a CEO and Executive Director of Azure Capital. Terence voted as the best country analyst in the Asia Money Brokers poll. Terence managed RHP Investment Bank's multi-award-winning research team in Singapore prior to founding Azure Capital. If you see retirees and elderly people following a man, they are following Terence. He's got a good following with the retail investors. So his views on the stock market with the media, he's also well quoted across both international and local print media. Jeff Harvey has more than 20 years of experience in financial markets and economics. He's the creator and author of the SGX My Gateway Report. Since 2012, he pens the weekly Insights column in the Business Times and speaks at Money FM 89.3 for the Market View Roundup. Mr. Harvey leads broking and market strategies roles across the Asia Pacific, offices of the world's largest futures and options brokers. Vasu, actually, he is also a regular speaker at seminars, very popular speaker at seminars. He was just telling me he's doing tens of webinars now, and you can always see him on television. And I used to pull his legs that plenty of girls must be following him. Vasu has played key roles in committees on the Singapore Exchange, SIS, and in 2017, Vasu was conferred the designation IBF Fellow for Wealth Management. Welcome, gentlemen, to this discussion. Thank you very much. I'm indeed very, very pleased that you make time away from your family to be with us. Now, by way of introduction, the spread of COVID-19 has dealt a severe, you would agree, a severe unexpected shock that has impacted people and markets around the world, around the globe. Many investors are wondering, gentlemen, how to navigate the supply and demand shocks and questioning where do we go from here. We are getting a litany of depressing data, all right? While clearly the scope and reach of the coronavirus crisis is unprecedented, we have gathered you today with your vast experience, to help us navigate this period of uncertainty and volatility. So, gentlemen, I would like to now start with the first question. The World Bank envisions a 5.2% contraction in global GDP in 2020, the deepest global recession in decades. Per capita incomes in most emerging and developing economies will shrink this year, they say. However, surprisingly, we have seen the stock markets make resurgence in the last couple of months, even when countries are still in lockdown. Are the equities markets predicting a V-shaped recovery, or has the market gotten ahead of itself? Let me start with Vasu.
Thank you, David. I think if you look at how the markets have done, somehow I have the impression that the markets are forecasting or imputing a V-shaped recovery. Well, the MSCI Global Indices Index fell by 34% over a period of 1 month after the outbreak of COVID-19. And over the next 3 months, very short 3 months, it rebounded by more than 40%. So it was down 34% in 1 month, up more than 40% in 3 months, right? And that kind of price action typically, I think, indicates to some extent expectations of a V-shaped recovery. But of course, there are other factors that also, have played a role in the market rally. A few factors. Number one, I think hope that reopening will result in pent-up demand, a sudden pickup in business. Hope that you will find a vaccine fairly soon, which is the cure to all our problems and COVID-19. I think that has been on investors' minds. You've had some near misses. You've had quite a lot of good news on that front. So hope of that as well. And of course, fear of missing out, what they call FOMO. Lots of cash sitting on the sidelines. We have an unprecedented amount of liquidity, David, sitting on the sidelines. I mean, just to give you an indication, if you pick US money market funds are where you park your funds as a temporary abode before you put it into riskier assets. And in the US, money market funds are currently standing at about $5 trillion US. That is a record high. Personal savings rates in the US and many parts of the world have increased phenomenally. So liquidity is abundant. Interest rates are very, very low right now. And markets are running. And the pace at which markets are running is causing nervousness among investors that perhaps they'll miss the boat, and that money is making its way into the market as well, right? So hope of reopening, hope of vaccine, fear of missing out, and of course, green shoots of recovery. You're seeing some signs of recovery. You've seen the PMI numbers improve. You've seen retail sales, for example, a couple of days ago in the US, shooting up yesterday rather. Retail sales went up 18%, defying market expectations. So some of these factors have come into play, right? And if you look at the price to earnings ratio for global equities right now, based on the MSCI World Index, and you take the 12 months forward price to earnings ratio, it is now about 4 standard deviations above the 7-year average. So typically, if it is 1 or 2 standard deviations above the 7-year average, it is already looking expensive. It is now 4 standard deviations above the 7-year average, which seems to imply that the markets are rather expensive at this juncture. And perhaps markets have run ahead of fundamentals, and the expectation of a V-shaped recovery perhaps will be unfounded, because it looks like we're going to see a more gradual U-shaped recovery. Just because economies are reopened doesn't mean that everybody will just jump onto the bandwagon. Business will pick up in a big way. Maybe it will for a short while, and then after that, the euphoria dies down, and investors and businesses and individuals take a more even keel. Now, so the P ratios look expensive, but David, if you flip to the other side, now the other measure of valuation in the market is this thing called the yield gap. So if you look at the S&P 500, for example, if you look at the yield, dividend yield of the S&P 500 relative to the 10-year US government bond yield, it is now almost close to a 15-year high, which implies that there will be investors who will continue to buy US stocks because US stocks continue to offer relatively attractive yield compared to risk-free rates. So that implies that the tide is still slightly in favor of equities. Now, the other measure of valuation, which I sometimes use, is what we call the gap between earnings yield and the 10-year government bond yield. Now, that gap as well is looking relatively okay. It's at about 4% right now, the earnings yield on the S&P 500 versus the 10-year government bond yield in the US, 4%. During the worst point in the global financial crisis, it was about 5.5%. So what I'm trying to say is that, yes, the P ratio looks expensive, but when interest rates are very, very low, sometimes it justifies a higher P ratio. And the fact that bond yields are so low, deposit rates are so low right now, means that investors have limited options. And so they are piling into equities. And so that means that although the markets seem disconnected from the fundamentals, don't be surprised if we don't see a big, big sell-off. And even if you do, it may not stay there much for too long, and the markets could see a fairly good rebound. Pick last Thursday, for example, the S&P 500 fell 6% in a single day, but it's rebounded quite a bit, and so I think this is a very unusual situation, David, where the economies are not showing the best of data, but we have a huge amount of liquidity because of unusual, unprecedented, massive policy stimulus. And don't forget, this is not your cyclical economic downturn. This is an induced coma. It is the government. It's an induced coma, if I may use it, and the government is a forced shutdown. It is not because of imbalances in the economy that we're seeing a recession. It's a forced shutdown. The good, the bad, the ugly are all forced to shut down. So when you reopen, markets are hopeful that maybe 2021 will get back to the 2019 levels. Okay. Maybe a bit of a stretch, but let's see. So that's what's happening in the markets, David. That's my general initial take.
That's a good lecture, Vasu. And Geoff, a U-shaped recovery, there may be a big sale coming, we don't know. And lots of people getting in. What is your view here on broadcast?
Yeah, I think equity markets and through all those indications of the equity markets that Vasu was talking about, I think they are very much watching policymakers, and the policymakers are in turn watching the economic numbers. The Fed, for instance, is watching unemployment, I'd say like a hawk, but that's a silly term. It's just watching the unemployment numbers first and foremost. I think you remember the non-farm payrolls. They came in with 700,000 jobs lost in April, but then 700,000 jobs lost in April, but it was 20 million jobs lost in April, I should say. And it was nuts. But then last month in May, it was less. It was much better. So what that's done is the unemployment rate's gone from 3.5% to 12.3%. But before the May numbers came out, we were expecting the unemployment rate to be 20% in the US. And at that time, I guess the Fed policymakers from the Dove, James Bullard, all the way to the chair the chair of the Fed was stating that they thought the unemployment rate would be back below 10% in December. So policymakers from a monetary perspective currently think the US is in the worst of it this quarter. And when they were expecting the unemployment rate to be 20% in May, they were thinking the unemployment rate would be back below 10% in December. So that's more, I guess, of a V down, but a little bit more of a U going up. The most important thing to all of this is it's what the Fed chair said a few weeks ago back on the 60 Minutes program. He said the GDP is to move back up after what's going to be the lowest of low numbers this quarter. And that unemployment's back to come down, then the big thing the US has to do is avoid that second wave of the virus or the extended first wave per se or so forth. But we're also not just living in the days of this extraordinary monetary stimulus, but we're in the days of synchronized fiscal stimulus, which is a very rare event as well. I think in Singapore, we're expecting our GDP to be down anything from between -7% to -4% this year. However, as we know, we got unity, we got resilience, solidarity, and fortitude budgets, and that's providing stimulus measures around 20% of our GDP. And if you go off the IMF tally, I think Thursday was their most recent update. They're saying the IMF is saying across the world the global fight to support the COVID-19 issues in the economy, it's at $10 trillion. So if you look at the global GDP pie at $86 trillion, you've got fiscal stimulus of around 12% of global GDP, and as we say in Singapore, we've got 20%. So these are some of the key factors that I think markets are looking at. First and foremost, looking at the policymakers, how the policymakers are using monetary policy, as well as these days of synchronized fiscal stimulus to address the issues. And of course, the policymakers know that the battle's not won yet. We have to win this battle with COVID-19 this year.
Yeah. Jeff, the markets are not performing in tandem with the reality of economies. I mean, the economies, global economies are showing, very poor numbers, but the markets are rising. What is really the reason?
Well, from an economic perspective, I've always thought it's the transmission mechanism. I know it sounds a little bit theoretical, but everything changed in that third week of March for the markets. The incredible effort that the Fed Reserve went to fix up liquidity of the US dollar and to basically make money as cheap as chips, which obviously helps investors for the corporates, but it also obviously helps Main Street, which is the investors for the small SMEs that are not listed per se. So I think the Fed was focusing a lot on the big businesses in March, and you can see that. I mean, the two key markets that we look at closely across the world in the equity world is obviously the US dollar and the 10-year yields, which have been so stable since the 23rd of March. I think in that third week of March, the 10-day annualized volatility of the US dollar index was as high as it's ever been. And we've seen swap lines, we've seen extraordinary measures again by the Fed Reserve to help stable that key asset class, those key asset classes, which has had an effect on the equity markets as well. But the key thing is too, it can't just stop there. And if you see the statements, I guess, of the Fed chair just over the week or so, there has been so much more focus on Main Street versus Wall Street in terms of the purchases of corporate issuances and supporting that very important employment driver in the US. And of course, we're seeing measures across the world and in Asia to support our SMEs as well.
Yeah.
I think Basu had a point over there. I mean, he was saying that there's this fear of missing out. There's like tremendous liquidity out in the system thanks to the Fed. And now people are so afraid, right? So there's a phenomenal amount of retail participation in the market, particularly in the US. So they buy everything. I mean, and they buy into tech. Is intuitive. That's going to be COVID is going to be positive for them. But then they're also going to buy into like crashed up sectors like cruise players, like airlines, and then they start to rotate into many different sectors. Those that are going to benefit from the opening of the countries beyond the lockdown. So there's just really like a lot of liquidity out there that's like pushing up the market.
Are you an optimist or a pessimist, Terence?
But I've done so many sales events, right? I generally am optimist. Some people even think that I'm a perennial optimist. But in this case, I think that there is a disconnect right now.
Disconnect?
There's a disconnect, a very clear disconnect between what's happening out there. There's going to be a lot of blood on Main Street, but yet places like in the stock market, we are seeing the markets in the US, they're flirting or already at all-time highs, right? And I think that again, they're banking, and I think that there's just going to be this V-shaped recovery, which I think is overly optimistic. It's going to be a protracted U other than a V-shaped recovery. And on the point that I think Vasu mentioned earlier on about S&P being 4 standard deviations above for the PE, and I think the scary thing is that as an analyst, and I've been a professional analyst for 16 years, right? We tend to be a little bit slow when it comes to cutting the earnings estimates. And now big companies like the likes of Starbucks, they're already telling you, I cannot estimate, I cannot give you any kind of forecast for this quarter or any time this year, right? What makes us analysts so smart to be able to estimate? And so when they do the estimates, they are not quick enough. And it's not only in the US. In Singapore, we are guilty of that too. We're very slow and measured. It doesn't fall like 10, 15%. Like when the earnings slump, it could go down 40, 60%, or even go into negative territory. So the earnings estimates that seeing of the analysts may already be optimistic, and yet it is already 4 standard deviations above.
Yes.
So I think that's worrying.
So we've been talking about, and everybody is, worried about the effects of COVID-19, the market and economy. But what are the other risks that we can really investors have to think about? I know Vasu touched on a few, but the US-China trade war, all right? The impending US elections, whether Biden will come in, or whether Trump will continue. Trade tensions between US and Europe. These have already created uncertainty for markets over the last few years. Are investors really to take good notice of these things? Are these real risks, Vasu? Basically, it looks real to me.
And you're not wrong, David, because they are real risks. So if you pick the US elections, which is probably the most prominent geopolitical risk that investors need to deal with, and we have the US elections, presidential elections taking place on November 3rd. So there are two aspects of the US elections. I would break it up into two aspects. First aspect is, as you highlighted earlier, US-China tensions, right? So I think in the run-up to November 3rd, you could see more China bashing taking place. And already, Trump is, the polls show that Biden is ahead of Trump. The national polls average show Biden now ahead of Trump. There are some who are disappointed with the way Trump has handled COVID-19, with the protests in the US, his management of the economy. And David, historically, when the US economy is in a recession, the incumbent president typically tends to lose. So history is not on Trump's side. If you go back all the way to the 1940s in the US, there's only been one instance where incumbent president has won an election during a recession year. And this is a recession year in the US. The Federal Reserve is forecasting minus 6.5% for the US economy. So yeah. Trump is presiding over a recession year. He's an incumbent. So he's fighting against the odds. The bookies also, have given Biden a better chance of winning against Trump. So he knows the odds are stacked against him. It's building up. So the risk is that in the run-up to November 3rd, he may use China, to bash. He may go all out with China. He hasn't done it so far, right? Everybody thought he will cancel the phase 1 trade deal. That is the ultimate. He struck a trade deal with China in January this year. Now, he has not touched a trade deal. He has not commented about the trade deal. He's commented about a lot of other things, right? He's been jawboning, there's been a lot of rhetoric, but the real action will be we cancel the trade deal, which he has not done. And Trump is somebody who watches the markets very closely. Markets tank, he sees it as a bad report card, right? So I think you never know. In the run-up to November 3rd, if he gets more desperate, he may go after China in a bigger way. And it's more than just a trade war, David. Trade war is where we started. Now it's gone into an economic warfare. It's gone into a political war.
Escalation of deterioration in the relationship between North and South Korea. And will America be involved there? Are they serious?
I think they are serious, but I think right now, it all ties in. North Korea is very aligned to China. So you don't know whether what's happening in North Korea, the boldness they're taking in terms of, blowing up their license office, in threatening Trump. Perhaps it's coming from the Chinese as well. They are fighting a proxy war on behalf of the Chinese, right? Because they are very close to China and Xi Jinping, right? So my point is that in the run-up to November 3rd, US-China tensions could flare up and the markets will get very nervous. Now, the other aspect, David, is that of the US elections is that what if Trump loses the elections? Is that good news or is that bad news for the markets? I mean, you know, and I know that Trump is not the most popular person, right? So news commentators, the media will not say the most positive things of him. But he has been good for the stock markets.
Yes.
He has cut taxes. He has forced the Federal Reserve to maybe lower interest rates. He's been good for the stock market. So if he loses and Biden wins, it may actually cause the stock markets to tank. Because Biden has talked about increasing the corporate tax rate from 21% to 28%, right? He's talked about, you know, challenging China and human rights and a lot of other things. He's talked about putting back regulations. He's talked about breaking up the big tax in the US. So
the Obama era might return.
That's right, precisely. Is that good or bad for the markets? So the outcome of the presidential elections, if Biden wins, may not be good. If Trump wins, ironically, it may be good because he's talking about infrastructure spending, payroll tax cut, all that is great for the market. So I think markets are looking at tensions on that front. Now, the other risk factor, David, which is not talked about enough, I feel, is the risk of corporate defaults, bankruptcies going up. So if you pick the US, for example, I think in the month of May, they had about 772 cases of bankruptcies. That's 48% more than the first quarter of last year. You know, so bankruptcy levels have not gone up to the levels of 2008, 2009. But there's a risk of that happening. If the economy is not able to get back on its feet, more and more companies, especially the big names, could run into trouble, right? So you've heard, for example, closing down, Kidzania is closing down, you know, so, you know, I mean, that's a risk. The risk is that...
I mean, after hearing you, gentlemen, I'm already getting a headache. I think I need to pop in.
No, but you see, David, the thing is that there are risks, but
so
there are also opportunities.
Question, gentlemen, let me ask Terence, you know, in spite of all this, the market, the investors, especially the new ones, are opening thousands of accounts, OCBC, UOB, DBS, reporting a surge in new accounts. Are people really taking cognizance of what you gentlemen are saying this afternoon? It's quite worrying, all right? A lot of worrying aspects. The risk seems to be stacking up. Terence, are these investors going to be happy or are they going to shed tears?
Well, it really depends on what they do with their account, right? I mean, if they attend SIAS classes and go for your conferences, then, you know, they are very learned and, you know, they do believe in fundamental analysis, stock picking and stuff. So these people are not so concerned about. The people that I'm worried about are those, the young ones that may not have enough experience, but yet they see the stock market just continue to march ahead despite the very weak fundamentals. Buy into flavors of the day, and these are the guys that will suffer. Because when
you tell them to take profit and walk off now?
Well, okay, it also depends on what counters we're talking about. Generally, I'm bearish on the markets right now. But then, of course, there are some that will outperform the others. So again, very stock specific. I believe that we're going to talk a little bit about that later on. But I don't like to generalize, but I do think that there will be people that will benefit and the others. But I do think that a bigger portion of those investors that recently started the account and they don't watch them, or they just listen to hearsay and they start rushing the stocks. These are the guys that will suffer.
Jeff, your take, Jeff. I mean, it looks like they're all rushing in.
It might look like that, but from our observation, I think some of the investing has been quite measured. If you look at passive investors, they've taken advantage of the volatility to add to their STI exchange traded fund positions. You look at the Spider STI ETF.
Yes, it's a bit hung. Can you repeat that? Can we hear that again? It's
that this month, that ETF, or at the end of last month, it's reached $1 billion in fund size. And if you look at the 2020 year through to the 16th of June, you've got at net inflows of around $380 million in this year. So this is this long-term passive way of investing in the STI ETF, which I think's generated 5.5% annualized total return since inception. So you've got that element. And then you've also seen, as I say, I guess the less passive investors, we've seen a degree of index or position portfolio rebalancing. in particular this month, if you look at the end of May and then for those first 7 sessions, we saw the market really get ahead of itself and rally. I think the STI from 25.11 up to 28.40 just in the space of 7 trading sessions. But what we saw was for those 7 sessions, for much of that time, the previous defensive stocks, the stocks that had actually generated the strongest returns in the year to date, those leaders became the laggards. And then the laggards like SATS or City Developments, Thai Bev, Singapore Airlines, Comfort Delgrove, for instance, they became the leaders where, as I said, those previous leaders like Logistics Trust, Ascendus Street and Wilmar, they became the laggards. So we've seen plenty of observations like that I guess can assure you that there has been some sensible moves in the recent months.
So what sectors should investors look to in the current environment, Jeff?
Okay, well, I guess it depends on the businesses. I mean, globally, it's been technology and healthcare businesses have fared the most. And that's one of the reasons the S&P 500 has been pretty strong, because the S&P 500, remember, 2/5 of its weightings are healthcare and tech stocks. I guess an interesting observation too is those stocks that were, I guess, more defensive in the first 12 weeks of this year up to 23rd of March have also fared pretty well. But, global digital businesses like Keppel DC REIT, they have performed really well. Keppel DC REIT, I might mention, its internet enterprise tenants make up almost 50% of its rental income. Who are those internet enterprises? Well, back in an AGM, I think back in FY18, the CEO noted we due to confidentiality with data centers, we don't reveal the names, but he did elaborate that they include hyperscale cloud providers that are amongst the largest companies of the world. And Keppel DC REIT has led the REIT market. So there's been that digital type of tech play, I guess, come out here in Singapore, but also healthcare stocks have been strong as well. The top quartile of all healthcare stocks across the world by market capitalization, they've generated median total returns, I think, of around 10%, nearly 10%, but the average return is significantly higher at around 30% with a big skew because of the performance of biotech, healthcare supplies and medical devices. So our IH All Healthcare Index, it's up 34% year to date, but it's mostly driven by Top Glove Corporation's 240% year-to-date gains and Riverstone as well, up 150%. So that medical supply benefit that we're seeing in our real economy with the manufacturing and the trade numbers, we've also seen it to quite a high degree too in our stock market.
Waiting for the company that will come with the cure for COVID-19, Jeff. I'll put my money on that one.
Well, we can't. That's Taichin. That could be Taichin. That's not listed yet. But,
yes.
But I do want to make a point too, because we do talk about liquidity quite a bit with our stock market here, and Top Glove Corporation, for instance, has been quite active here in Singapore. The executive director, Mr. Lim, he's done events with us here and see us quite regularly. And look, while the stock price is up 200% year to date, I think for us the good news is the turnover in the stock, the daily liquidity, that's up almost 4,000%, up 40-fold, if you will, and trading $1 million a day on average this year.
Terence?
Top Glove is a secondary listing over in Singapore. Its primary listing is in Malaysia, which is already one of the most popular. It has been one of the most popular stocks for years. But Top Glove, if you look at the numbers, it's really quite mind-blowing, though it has appreciated a lot. But I think that going ahead, if you look at demand, the orders have been going up crazy numbers, and we're talking about some of these guys having to wait almost a year before getting delivery from the likes of Top Glove, Max, and the Malaysian guys, they account for 65% the total global supply. And like I said, mind-blowing, because if you look at the stars are all pretty much aligned for this particular sector. margins are expanding and are getting increasingly large because it's priced in US dollars and the cost is in ringgit. So margins are there, and ASP is the average selling prices. Every quarter they're adjusting it by 5 to 10%. So I think that in the next 2 years, this year as well as next year, likes of Top Glove, we're likely going to see earnings explode up by about 8 to 10 times, not 8 to 10%, but 8 to 10 times.
So the listeners are all ears. Technology, healthcare sector. What
Right.
else, Terence?
What? Sorry.
What else? What other
Okay.
sectors?
Okay, but healthcare, I have to be a little bit more cautious.
Yes.
Healthcare in general, because we're not talking about the hospitals, the clinics. There are a lot of healthcare guys that are in this space. I just went to a clinic earlier on, and the business was really because people are not getting sick. If you look at what's happening, Straits Times reported last month that people have less diarrhea because they go out eat. They're eating largely at home. They don't get sick that often. So the clinics and because we are in a semi-lockdown condition, right? So nobody really goes out. So the clinic guys don't really see any kind of benefit from the current situation. But it is the healthcare supply guys, those supplying the PPEs, the masks, like medtechs. They're also going to see an earnings explosion. Some people like to play supermarkets, but supermarkets.
Right? We are on sectors now. What do you think of the banking sector?
Okay, I think the banks, there are a few things that's happening to the banks right now. I mean, given that interest rates are falling, the NIMs will actually compress, and that's bad for banks. NPLs, something to watch out for because there's going to be more bankruptcies, right? I mean, Basu was alluding to that, totally agree. And that will also hit the banks because of the current situation. Generally, corporates are, they're really encouraged to borrow more, but then some of them, if they really fumble and they're scared, I don't see that loans growth being a big part of the bank, at least in the next 6 to 12 months. So all these are working with the banks. And I think that, in the near term, there will be better investment opportunities other than the banks.
And these are long-term, we are talking about long-term investment opportunities and stayers and not the runners for this. Vasu, your gold, I mean, I wanted to ask you, gold has done well this year. Do you see more upside for the precious metals?
You're right, David. Gold has done well this year. Just to give you an idea of the numbers, gold price is up almost 14% this year, year to date. Global equities are down something like about 6% year to date. So effectively, gold has outperformed global equities by about 20 percentage points. Now, that's a very big outperformance. We think there is more upside for gold. Gold is emerging as an asset class, a very distinct asset class. It is an excellent portfolio diversifier. It is excellent insurance policy to buy for your portfolio. Because gold is a hedge against uncertainty. And uncertainty, David, is going to be with us for a long time. Even if we go past COVID, there could be more crises down the road. We are now living in a new normal. Uncertainty has become a fixture. Investing based on blue skies, I think it's now out of the window. Investors have to live with this perennial uncertainty. And so there's going to be demand for gold. And central banks are what I call de-dollarizing their portfolios, or their reserves rather. So what I mean by that is that they're reducing their holdings of dollars and instead, buying more gold. So the central banks of Russia, China, India, several other central banks have been, buying gold, and institutional demand for gold is increasing. Retail demand for gold is increasing.
Yes. Is there enough production?
Pardon?
But is there enough production of gold?
Well, that is the beautiful part, David, because gold is limited in supply, but demand is growing for it, and so there is more upside for gold. So in the next 1-2 years, if US dollar weakens because of very loose monetary policy for the Fed or whatever reason, essentially gold will also benefit from that. The low interest rate environment, interest rates will stay low until maybe 2023. That's also beneficial for gold because gold doesn't offer you any kind of carry. So put all that together in a nutshell. You must have some gold in your portfolio. Not a lot, some gold. It's part of your overall asset allocation strategy, diversification. Have some gold. It's like buying an insurance policy.
Yes. Geoff, what would be the impact of oil, the prices, performance of oil, how is it going to impact the markets?
Yeah, I mean, well, unlike, I guess our market, local market, is a lot more correlated to crude oil than it is gold, and that's what makes gold such a good hedge. Before I talk about oil, just to point out that our gold ETF here has just slightly outpaced the STI in the year to date. So if you went into 2020 with a 50-50 portfolio that was half gold, half STI, your return would have been marginal return of 1%. But having some portfolio, obviously, as Vasu said, it's usually a much smaller than 50% amount. I think the World Gold Council suggests it should be somewhere between 5 and 10%, just to to have in your portfolio, because crude oil can very different, can be can obviously move around, but most of it is being driven by demand factors at the moment. Obviously, we have some we have some stocks that obviously are in the oil and gas exploration, production and development business, and Rex International has been the strongest of that in terms of turnover and performance. It's has its interests in Norway and Oman that where it's exploring, and it also has its own technology. But look, as we say, David, that there is some convergence here across these big major cyclical asset classes that have the same potential demand issues that we all have. Terence was saying that there's real effects in healthcare. There's also real effects with not using as much electricity and as much power, and obviously grounding all the airports and so forth. So so it's all connected is the long-winded answer.
So the property sector, the property market has slowed down last 2 months. Terence, you think that it'll return? The euphoria will return?
Property market has been semi-dead. It's like zombie state, given that nobody can go out. And I've got a lot of agents, because I'm investing. A lot of agents on my Facebook, and I noticed that there are people that say, oh, I've done off Zoom, it's great, and everybody's cheering them on, but these are few and far between, right? The reality is, as long as people cannot go visit the place, it's very, very difficult to sell. But now with phase 2 opening up, I think that's going to be positive for the agency as well as some of the property guys. But in the bigger, longer run, I feel that volumes will actually come. The volume will come off. That's a certainty for this year. Prices will also come down, perhaps by 5 to 10%, but it will not be as drastic as what we saw in GFC. GFC at that point in time, because a lot of the developers, they bought land cheap, and during when the price when they started to sell, they sold it at a huge fat margin, 25-30%. So when 08 came, 09, and everything just fell through, the developers could actually cut, and they could cut significantly, maybe by 30%, and yet after cutting 30%, they are still earning decent margins of 10%. But in this case, a lot of the developers that are pushing out their products right now, they bought it when? They bought it in 2017, 2018, during the en-bloc craze, before the government came in with the cooling measure in July 2018. So the prices are really very high. And there's very little wiggle room right now. Their margins may be 12, 15%. If they cut anything down, it'll be bones. So they'd rather not cut. So that's one positive thing. Another thing is we've been talking about low interest rates, ultra low interest rates, that will ultimately, I think, in the mid to long term be beneficial. Not now, probably, because people are still worried about the jobs. After job support scheme, we come up, we're not very sure whether we're still going to have a job, right? So in the next 6 months, it's really going to be telling. So that's going to be crucial, the jobs environment. But interest rates are low, and if they will continue to stay low, so that's going to be positive for the developers in the mid to long run. Another thing that's going for them is that unlike 08, 09, we do have a lot of policy levers, because over the last 6, 7, since 2010, right, over the last decade, the the government have come in with cooling measure after cooling measure after cooling measure. There's 10 rounds, right? So if the government want to help developers, I mean, developers have been bitching about government all this while, but if they finally want to help the developers, they can just unwind some of these measures, right? ABSD and all. And that could help. That would help them. And given that some of these property developers, now I'm talking about that's the physical front. That's just the company on its own. We're talking about the valuations. The valuations of a lot of these developers are trading anywhere between 40 and 60% discount to RNEV, which I think is very decent.
And can we anticipate Hong Kong money coming onto our properties?
Hong Kong money, is it? Okay, anecdotally, I have heard that, but MAS, they have been saying that, oh, it's not just Hong Kong, it's basically a basket, and then there's money coming in and out. So I'm not altogether sure, but I've got a lot of developer friends, and I do hear, you know, like when the crisis first broke in June 2019, there were a lot of inquiries, and moving on to, right, there are still increasing inquiries of
Yes, British Prime Minister is offering 3 million visas. Oh, you know, he's attracting Hong Kong citizens to go there. But I was just thinking, Singapore properties have always been touted by, you know, people around Southeast Asia and Asia and South Asia, East Asia. So that could be a possibility. But gentlemen, the final question from me would be the interest rate on US 10-year government bond yield has fallen from 3.2% in February 2018 to 0.73% now, offering very little potential for further gains for bondholders. At the same time, average stock valuations are quite high. So how can investors make their money work for them? What other opportunities should they consider? Or should they simply keep cash because cash is king? Is that right, Vasu?
I don't think cash is king. If you look at deposit rates right now, they are very, very low. You know, effectively, they are giving you negative real returns because if you impute inflation, then it's negative real returns. You know, and so cash may not be necessarily king. I think a better strategy would be to basically, I mean, you need to diversify your investments. Keep diversified, right? Don't put all your eggs in one basket. I mean, we've said that numerous times before.
Yes.
Heard this before, right? I mean, I'm sure many investors are quite sick of listening to it.
Yes.
But in the next few years, markets will run into quite a bit of uncertainty, turbulence, COVID-19, and a host of other factors. So I think, how do you make volatility your friend? I mean, stay diversified. So put some money into equities, put some money into bonds, put some money into gold, and within equities, you know, diversify across the regions, diversify across different stocks, different industries, different sectors. And I think most importantly, perhaps also diversify over time. It's extremely difficult to time the market. And I'm a firm believer in incremental purchases where you phase your investments into the market through a dollar cost averaging program and do that over the next 12 months, 18 months, or maybe even longer. But to stay completely in cash and try and time the market and pick it right at the bottom, if you're lucky, yes. But more often than not, what happens is when the markets come off very sharply, like what we saw this year in March, most people run and hide for cover. And when the markets initially run up, I think people are skeptical.
Yes.
And so you know, it's very difficult to pick the bottom, David. And so let me put this across to you. Our valuations are high and so on and so on. What if a vaccine is discovered in the second half of this year? What do you think the markets are going to do? The markets are going to, I think, respond very positively. So yes, so I think you cannot wait and sit on your hands and do nothing, right? So while the markets have run up very sharply, I think what has happened is the technology sector has taken the lead. So if you pick the S&P 500, as Jeff mentioned earlier, you know, 40% is healthcare and technology, 20% is technology. And if you take away technology and you take away healthcare, then, you know, some of the other cyclical sectors have not performed as well. When I mean cyclicals, you know, like we talked about the banks, we talked about automobile stocks, we talk about, you know, airlines, we talk about energy stocks. These have not performed, you know. So you could see some degree of rotation take place if the economy gains some traction, money rotating out of the, you know, the growth sectors towards the cyclical and the value stocks. So what I'm trying to say is that there are always opportunities in different stages of the market cycle, right? And you can always find good dividend yielding stocks in Singapore, right? If you just pick the STI index, for example, and Jeff will tell you this, I mean, it gives you a relatively good yield of like more than 4% versus, deposit rates which are very, very low. I'm not suggesting you buy it, but I'm saying that, in Singapore, you can find numerous stocks that give you yield. So you want to buy some stocks that give you yield, some stocks that give you growth, some stocks that are value. So it's a combination. And I think importantly, stay invested because all of us need to grow our money. Especially young investors. I mean, you're going to get married, you're going to buy a house, you need to send your kids to university, you need to get retired yourself. Investing is not an option. It is an essential service, to put it in COVID-19 terms, right? It is not.
Invest with knowledge and not gamble.
Precisely. Do not gamble. Do not gamble. I think, David, the risk is
diversify your investments to reduce your risk.
Precisely. As Terence said, the risk is that people jump onto the bandwagon on hearsay.
Yes.
And I think Terence and Jeff have just given quite a lot of good advice in terms of, sectors to look out for. Start with those and then expand your horizon because, I think do your research, be patient. Investing is not exciting, but it is necessary.
Yes.
And it can yield you returns in the longer term.
Yes. Last year, SIS did 70 investment programs. 70 investment education programs and a lot more. Money Sense provides. So plenty of opportunities. And Jeff Harvey comes up with almost daily with his, write-ups and recommendations. And he analyzes. And where do they go to on SGX? It's a gateway. Can you guide them?
Yeah, I mean, we have heaps of services. We've got a new online CDP service, which is designed to be a one-stop shop for investors to access their accounts and run some analytics on those accounts. And there's a lot of educational material there as well. The newsletter that we write is also pretty big now. I think 320,000 subscribers.
Yeah.
And that goes out every Monday night. And we've worked together in building that newsletter, David, over the years. But yeah, there's plenty of services there. But if I may just quickly point out and add to what Vasu was saying that, and what you're saying too, we have a very diversified stock market. There's always something to write about every day. And and look, even just looking over the past few months, there's been essentials that essential businesses here in Singapore that have still seen transactions. And like Terence was talking about property, we saw the primary sales numbers up. There's still people that need to buy homes, which are providing a little bit of a cushion. We've still got companies like Sheng Xiong Group that reported, I think, net profit growth of 50% on a lot of the buying that in those first 3 months of this year. So there's those stocks that fulfilled that I guess that market need over the past 4 or 5 months or so. But there's also who knows what lies ahead. As Vasu said, there might be a vaccine, as we all fear, there might be a new second wave. I think key is if you want to look in the equity market, maybe cash is the ace card. You keep up the sleeve and hold it for a rainy day or until there's a little bit more certainty in the market.
Yes, and Terence, they all need knowledge. They all need education. Or they need information. They need to analyze. They need to see which are the companies that are well governed, and not which are the companies that are taking off, in price. They need to know the fundamentals, right? They need to, could you round up on the essential things that investors should be doing before they start investing? But they must keep investing.
Totally agree. I think this is no different from, when I give the seminars for SIAS over the last 2 decades. We've been always concentrating on the fact, whether it's COVID times, we still need to look at the fundamentals of the companies, understand what the company is doing, like conferences that you guys give, it gives you a good opportunity, and I give investors a good opportunity to actually meet up with the management. And I think that's very, very important. Nowadays, versus say 15 to 20 years ago, there are a lot more opportunities to, understand about the company. That the information has just been democratized, right? So you can get it off the net. And if you don't want, and if you really want to know more, IR, a lot of companies, they do have the IR personnel to actually assist you. So there's really no excuse not to be able to find out more of the company. So it's really about understanding a company. And sometimes I think if you look at the valuation, people talk about, to us, it may seem very intuitive because we study that, talk about that, we think that in terms of numbers. To retail investors, it may not be as intuitive. Do check out analyst reports. Don't just look at the recommendations though. You know, I did a magazine cover where I told Pulses magazine that, you know, don't trust analyst reports when I was an analyst, right? Don't just purely the recommendation. Look through, you know, the ways of analyzing, you know, what the industry is like, and look at their forecast, right? It may not be the gospel truth, but then you can check out the forecast and you can look at valuations and counter check with the other analyst reports. It's best. I mean, like if you are a new investor, there are many different sources of information to check those.
So investor education is plenty. No excuse for learning, getting knowledge. And SIS will very soon also come up with, guidance notes on risks, factors in companies, and getting the companies to comment on what they're doing about it. Are they overgeared? Are they shifting their core business? Are they, having problems with governance? So we're going to cover all that, and the market will not have any, the investors will not have any excuse. So now we will now address some of the questions posted on the Facebook to you gentlemen. Will unlimited QE accelerate the valuation of US dollars, and how will it affect Singapore dollars? And it's currently rally generated by FOMO and many retail rushing in.
I think the question, did it?
Yes.
Okay, so essentially, QE, in some ways, you can say QE is not exactly the best piece of news for the US dollar, because the Fed is injecting so much of liquidity, supply of US dollars, increases. So it, in some ways, weighs on the US dollar. So if you pick, for example, since March this year, when the Fed announced massive QE, they announced massive measures, right, to support the economy in the face of COVID. Since then, since March, the US dollar has weakened quite a bit against major currencies, including the Singapore dollar, the Australian dollar, the euro, and so on and so forth, right? So essentially, when there's QE and there's confidence and there's hope, risk appetite picks up, and that weighs on the US dollar, because the US dollar is seen as a safe haven currency. So when it's risk on, it's not the best piece of news for dollar. And risk on normally happens when central banks pull out all their firepower, as in QE, and inspires confidence, and that weighs on the US dollar long term, right? FOMO, as the question said, is very much there. You are seeing it happen. I mean, the number of accounts being opened. I myself personally have had personal friends, many of them, calling me up and say, Vasu, I've got a certain amount of money. What do I do now? Because essentially interest rates are very, very low, and the stock markets appear to be doing well. I mean, I kind of missed the boat because I didn't see the turn happening. It's gone up quite a bit, and I want to buy. So what do I buy? So I think these factors will be there. And David, I mean, if you look at the deposit numbers, if you look at the liquidity on the sidelines, it's quite big and it's quite massive, and and it could still provide that backstop, the floor for the market. So I find it hard to believe the markets will go back to the March lows. I don't think that will happen unless we have something that's totally unexpected, a black swan event. The second wave proves to be a big wave, much bigger than the first wave. Then I think maybe we'll go back to the March lows. But otherwise, if the second wave turns out to be not as significant, then all that money will be looking for a home.
Yes. Jeff, have you anything to add?
Just that it is a really good question, and it's good that the investors watching the equity markets in tandem with the US dollar, obviously, because that was, while the equities did see that big sell-off for those 2.5 weeks in March. At the same time, the US dollar, all that rotation into the US dollar that Vasu mentioned, saw the US dollar appreciate by 10%, which is an incredible move in the case of 12 days for the world's reserve currency. And hence, you remember You know, the Fed Reserve opened up emergency swap lines with the MAS and so forth, and it did that with central banks all across the world. But so it has served as a little bit of an indicator for global stability. The volatility, as we said, has come right down, so much so that the US dollar recently was trading almost back to where it was prior to the big upset it saw in mid-March. So yeah, it's definitely one of the right markets to keep an eye on. While you've got one eye on equities, keep the other eye on US dollars index, and of course the 10-year Treasury yields.
Terence?
Well, speaking of black swan, I just think, you know, well, it's not exactly a black swan, but then there could be some potential issues in the second half of the year, second wave being one of the trade. Early on, we spoke about US-China trade deal, and I'm just a little bit puzzled. Of course, nothing is cancelled as of yet, but then you can see a lot of rhetoric and threats by Donald Trump, and I'm just a little bit surprised that, you know, the tech stocks continue to be super resilient amidst all these things. If you recall, if you look back at when he bought his first salvo in March 2018, our manufacturing and tech stocks really got hit because many of these manufacturing guys were have facilities over in China, and they're not very sure about what's going to happen. Subsequently, in the next few months, towards the end of 2018, the likes of Apple got hit because the bulk of their, a big part of their manufacturing facilities is in Foxconn, which is in China. It's done by Foxconn in China. So that could very well be an issue. I think the trade war, which you know, to a grander scale, maybe economic war between China and the US, and look at it at a more macro level, geopolitics is going to be an issue. There's an army of unemployed people all across the world because of COVID-19, and I think that, you know, because of that, could be potential flashpoints out there. Already we are seeing things like earlier we spoke about North Korea and South Korea. There's China and India right now. Dozens of people have passed on. It may not be altogether unrelated, you know, because I'm a great fan of this movie called Wag the Dog. At that point in time, you know, when there's trouble at home, the US president actually waged war outside, right? In some, I think in Albania or something like that. But this could very well happen, and we're not talking about real war. I mean, countries are under a lot of pressure, and they need to appease, and they need to get the attention away from this. And when that happens, I believe there could be friction in countries, and that could be a potential black swan people are not talking about, and that could actually hurt the markets.
Well, would solvency risks and bankruptcies of companies in the US lead to subsequent crisis or lengthen the current crisis? Basu, I suppose you can.
Sure. I mean, I did talk a little bit about you know, defaults and bankruptcies and so on and so forth.
Yes.
So if you go to Bloomberg, for example, and you do Bloomberg US dollar, you know, corporate default index, what you see, I can't show you right now, but if you have a ability to go to Bloomberg, what you see, I can describe it, is that you see the index picking up. It has turned the corner, picked up, and indicating corporate defaults are on the rise. But the index is now at a level which is nowhere near what it was in 2008, 2009. Right. So we've not reached the extent of bankruptcies and corporate defaults that you saw back in 2008, 2009, that resulted in a systemic financial crisis. The banking system was under threat because of all the bad loans, and it created a systemic problem. Financial crisis then emerged. What we have is a health crisis that has become an economic crisis, and it is starting to result in defaults, but we've not seen defaults reach that level of 2008, 2009, hopefully not, but we are keeping a very close eye on corporate defaults. If you see the numbers continuing to get higher, then, you know, the markets could start worrying about the banking system and whether you'll have more NPLs and other things, you know, and that could be a potential flashpoint as well. So, you know, there are a lot of moving parts here, David, and
the governments are injecting, and there's a lot of financial help going to SMEs and companies and
That's right, they are. But governments are not bottomless pits, right?
yes,
I mean,
of course.
Singapore has a huge amount of reserves, so we've been able to dig into reserves. But many other countries will have to go back to the debt market to raise debt. And for example, in the US, all the measures they've announced, fiscal policy, can only carry them till July 21st or something like that.
Right.
Beyond that, they need more. And how do they fund all this? Debt. And my fear is that many years down the road, the day of reckoning will come and all these governments are sitting on a pile of debt, and we then have a sovereign debt crisis. I mean, it's not there, but it's something to think about.
Yes. So it seems there is consensus amongst you gentlemen this afternoon that investors will have to invest and stay invested, choose their investments carefully with sound fundamentals. And you have also talked about the great prospects in the technology and healthcare sectors at the moment, but there are other sectors that are also looking quite promising. So you need to do your homework. Please attend investor education programs. That's very important. Experts like these gentlemen do appear in many of the investor education discussions, training programs. There are others doing trainings. Just look up the websites of SGX, SIAS, Money Sense, and also all the securities firms, banks. They have for their own clients training programs. There's, I had a doctor who came up to me. She's a gold medalist, and she didn't want to start investing until she came for investor education. This was about 10 years ago, I think. And she did well because she started with knowledge. She didn't just jump in. There's plenty of time. And Warren Buffett said, when everybody moves away from a company, that's when he goes in. Everyone's frightened to go in. He looks at the fundamentals and he says, look, I'm going to stay in this company and grow with this company. So thank you, gentlemen, for spending your time this afternoon. I'm sure our audience have benefited greatly from your wisdom and from your experience and for your guidance. Thank you. Have a good
Thank you very much, David.
Thanks so much.
Yes.
See ya.